All right, Eric, and we're live, mate. Take it away.
Beautiful. Welcome back to the Eric Crown Crypto channel. I'm joined here today by Mr. Ted from TedTalksMacro. Major appreciation to, of course, Crypto Ed NL for the introduction here. Whoopsies, I have that in the background. Beautiful. There we go. And I wanted to really contact you and kind of get this conversation going because I was introduced to you through Ed, who I have a humongous amount of respect for. And I started reading through your feed on Twitter, especially where you have a humongous following at TED Talks Macro. And basically you were putting words through a fundamental narrative that I'd been looking at from a technical perspective, which I thought was insanely interesting to myself, as it's essentially, divorced from the way that I look at things, but it was very much in agreement with it. So I wanted to kind of pick your brain about the macro situation, what you're looking at in the next, 6 months to a year. I know that you're very much into analyzing what the Fed is doing and what that means for the markets. And so I will let you kind of just take it from there, and then we can let the conversation go where it goes. But essentially, I suppose the best way to kind of start it off would be, well, what's the most relevant and recent thing that we should kind of be aware of here?
Yeah, perfect. First of all, Eric, thanks for having me. It's a bit of an honor to be on with you, someone who I've looked up to for a little while now. Only just recently, actually. I scrolled. Was speaking earlier. I was scrolling through YouTube one day and stumbled across one of your videos, and here we are. So, and then Ed, who I also respect massively. It's good that he puts me in touch with some level-headed people in this space, which is awesome, because it's hard to find those people sometimes.
You got to grip onto them.
Yeah, exactly. That's it. You got to grip on and hold tight. So, yeah, the macro situation right now is pretty. It's becoming even more and more spoken about on Twitter. You'll see it on Cointelegraph and all those type of places. So it's in the forefront of everyone's thinking in crypto, whereas previously, maybe 2013, 2017, we weren't so susceptible to what was going on in the macro space. And I'll go on to talk a little bit about that as well, because I think that's pretty important to understand on why it actually does matter. Because, previously you could probably say it didn't really matter for good reason. But now I think it's becoming more and more and more prominent, and it's going to have a pretty significant effect on the markets, from here on out into the future. So I'll touch on that first, if we don't mind. I'll just bring up my screen here, Eric. All right, so we'll go on about that chart in a minute, but what I really want to talk about is this thread that I put out the other day on Twitter. So the thing that I've noticed the most recently is comparisons between what happened in 2013 and what happened in 2017, obviously previous bull runs, and it was just up only, as you would know. So let's talk about what was going on there. So we had, mostly a retail crowd. There was barely any institutional interest because, one, it was just the Wild West of financial markets. No one knew pretty much anything about it, and for good reason. There's a lot to know, specifically if you're managing large sums of money. And with those large sums of money, you're pushing, you want highly liquid assets to be able to efficiently trade, and you also want to protect any trade that you do put on. These large institutions aren't just betting in one direction. They're hedging their interest via derivatives markets. They're not just buying spot and holding and hoping for the best, which is what retail did, right? So back then, retail was driving the markets. And you might have had some big players that moved from coin to coin and just pumped and then dumped. You saw that quite often. But that's not really happening anymore. And I'll just explain why I think that's happening. So, scroll through my thread here. So, as we spoke about, up only was previously attributed to retail investors bidding up spot products. So, the crypto market was very aligned with spot only. They didn't have options.
Spot driven.
Spot driven, yeah. So, they didn't have very much a lack of futures contracts, perpetual contracts, all of those things that allow you access to leverage and allow bigger players to, efficiently participate. They didn't have all of that. So that's what I'm trying to say here. And for those that aren't aware, spot products are, you're holding the asset, that, the real asset. So real Bitcoin Some will say that it's not even real, but it is real, and it's differentiated from a derivative of that. So derivatives are options contracts, futures contracts, those perpetual contracts, and those products that you can access leverage. Whereas spot, you can only, if you have $50,000 worth of, US dollars that you want to put into crypto, you can only, use that $50,000 to buy spot. You can't use leverage when you're buying spot products.
What? No 5 million?
Yeah, exactly.
No 100x on that?
Yeah, so that's what you're seeing at the moment. And this chart here shows how the trading volume of Bitcoin and ETH options has increased by around 450% in 2021 alone. So,
Jesus.
Yeah, and you're actually seeing in traditional markets the options market volume overtaking the underlying volume. So S&P futures, S&P 500, options contracts and the options trading volume is actually overtaking what is being traded on the underlying. So
that does kind of make sense, just because, when I was trading equity options, we had weekly expirations, and before it was only monthly expirations, for like the eternity of time. Now that for S&P, it's like 3 times a fucking week or something. It's at least two, 3 times a week. It's insane.
Yeah, it's insane. It's crazy. And, you're seeing FTX and other exchanges move into the move contracts, which is essentially a straddle contract and straddle strategy. Sorry. And
correct me if I'm wrong.
Daily.
If you don't mind, correct me if I'm wrong on those. The move contracts, I haven't looked too much into them, but from what I understand, they're essentially options where you can only be on the buy side. Is that right?
You can short them, so it's being long or short volatility. Right. Yeah, there's more info on their website.
Interesting.
But, all right. Yeah, you can sell them. So you can be long or short volatility.
Gotcha.
They set the index, the strike price, and you can trade those daily, weekly, monthly, quarterly, I believe.
Okay.
So you're seeing just more and more derivatives products enter the space, and with that comes leverage. It comes liquidity. More capital can participate more efficiently. And that's where institutions start to see, okay, we can come in and we can start to participate in this market, where previously, we only had spot. We could only, hold and go to the moon, and that's about it. But now they can, be executing option strategies. They can hedge their interest by shorting a perp. They can do all these different things. And with that comes a different dynamic on the market. So, it's going to, you're seeing Bitcoin derivatives, the options, open interest in the market, in the derivatives market, is at all-time highs, even though
absolutely
you're seeing these. Yeah, it's insane. So it's just continuing to grow, and it's going to continue to grow as this market grows. And there's just a different dimension that brings to the market now. As I said, like options contracts, they offer a cheap way to speculate and access to leverage, magnifying investment gains and losses. So with that comes liquidity hunts from bigger players that see, vulnerable participants, easy people to take money off, who are just betting on some ridiculous things. So there's just a different dynamic, and I think that's why you're seeing the price action that you're seeing. You go and look at the currency market, or look at the commodity market, and it's just ranges in the odd trend, and then it just ranges, dump on news or whatever, and it just ranges into eternity. So it's kind of what you're seeing in Bitcoin right now.
That does make sense. I mean, what is the saying? Like 70 or 80% of options expire worthless. And we had to say, I actually used to be an options market maker in equity options. And one of the sayings that we had was options were created to be sold. That kind of makes sense in the context of what you're saying, because, well, obviously you're going to be playing ranges rather than just like looking for the moonshot or the doom shot, because they don't really happen all that often. It's more just like box trading.
Yeah. Unless you get, an unprecedented macro environment like you're seeing, well, recently you saw. Sorry, I just down a little bit of water. I was chatting a lot there. Sorry, Eric.
Right on. It's all good, man. I totally get it.
It's good to get in a flow, but at the same time, you don't want to overrule people. But please let me know if I am.
Oh, you're all
so.
Did
you have any thoughts on that? Like you're saying that you were previously an options market maker. What are you seeing with the derivative space?
Well, it's definitely evolved since I started to look more and more into the crypto space. I came in like 2016, 2017, where, 100x leverage contracts were kind of like the going rate. BitMEX was king around
Yep.
that time. And now it's kind of evolved to a little bit more reasonable. Well, in comparison to 100x leverage, like 20x leverage, I think is kind of a little bit more normalized now. And then options become more normalized as well. But the thing that I really noticed in particular with just options in general, whether it be traditional or crypto, whatever, retailers typically look at options in like a long only fashion, and it's like a lottery ticket basically to heaven.
Yep.
Whereas, what professionals are doing with options is they're usually playing delta neutral strategies. They don't really want to be
Exactly.
playing directional risk. In fact, if you're playing options, if you're playing direction, you're not using options in the way that they're meant to be used. If you're trading option to option, you really want to be making volatility plays, and that's what you're focusing on. You don't really care about directions.
Yep.
This is why I figure, we kind of move in like boxes, which you basically see a box now between what, 60, 70,000 and $30,000 low, probably hanging
Yep.
that for a while is my kind of ideas right now.
Exactly, because if someone's long volatility or short volatility, they have an incentive, like particularly market makers or those larger players. They have an incentive to push price in one direction or the other. So bottom of the range,
Right.
like, nah, I'm short volatility or whatever, and then
Yeah,
they pump
exactly.
it back up into the range, and
Right.
then it's a never-ending cycle
Mm-hmm.
until there is that clear, direct, whether that comes from central banks or there's some kind of trend sparking move.
Right.
It's hard to, because when I traded FX and I traded commodities, basically all I was doing was using news catalysts to
Right.
get that volatility pocket, and where could typically get a good gauge on what was going to happen and what the data would do, and then you could get those 100 pip moves or 50 pip moves towards 2020. You could get those moves pretty easily with managing your risk pretty tight. But the FX market, it's very, very, very hard to trade because it's just run by banks. It's run by institutions, and that's where the crypto market is going, I think.
Yeah, I mean, it makes sense. I mean, it's not like Bitcoin has earnings reports or anything to price it off of. It's probably gonna be priced off of tentacles and a few macroeconomic events.
Yeah, cool. So I'll just get into this now, Eric. So what I've got here is Bitcoin on the top. I've got the Federal Reserve's balance sheet in the orange there in the middle, and you've got the Nasdaq on the bottom. So the technology index in the US. So 3 charts there. So really, I guess the point of talking about the derivative space and why that's evolving so quickly and the effect it's having on the market is those institutional players can participate effectively and efficiently in crypto now. So that is, a smart crowd, a smart money crowd, as you would say, and they pay attention to the macro. So that's why macro matters now. Whereas previously, these guys didn't really participate in crypto. So, you could really shrug off what was happening in macro. Like people were talking about the Fed hiking in 2017, and we still had the big bull run. But, it wasn't really relevant back then because of what we just spoke about.
Right. Different participants.
Exactly. Yeah. Well, you might have, those same retail participants, but now they're being diluted by the interest that institutional.
And to be fair, institutional crowd, man, like these guys are dealing with billions and billions, whereas retail is just a drop of piss in the ever like ocean of, of what's available. So it really doesn't amount towards much.
Yep. Yeah, exactly. And they're probably going to have to go further and further along that risk curve that exists within crypto. You've got like your large caps, you've got Bitcoin, you've got Ethereum, which previously like pumped and you could trade those fairly easily and get a nice trend going. But now you're seeing consolidating price action, and which is, you see ETH, Bitcoin options, you see massive derivative products focused on those 2 coins.
Right.
And those are the 2 coins that seem to have the most painful price action right now.
Right.
Whereas
I mean,
caps.
Yeah. Right. Well, you raise up a perfect explanation right there, because when you look at some of like the very deep altcoins, like the ones that are completely off the board, they do still kind of display that behavior of just moon and then doom, right afterwards.
Yeah, exactly. Yeah, because they don't really have that interest yet. Like this, I'm sure they still have, venture capitalists and guys like that moving these coins about and having some kind of interest, but there's not really that that option contract available for them. There's not as much available to participate efficiently, whereas Bitcoin and Ethereum, that they're seeing a lot more availability of those products to effectively participate with large sums of money. Okay, so I guess taking the macro scene back to what happened in 2020 up till now, so the best part of 2 years worth of what's happened, I just want to kind of explain and give some context around what has happened up until now. So as everyone knows, March 2020, we had equities at all-time highs up here. We had Bitcoin. What was it at back then?
About it's like 10,000, 11,000. Yeah.
Yeah. And then all of a sudden, the market was trending along nicely. And then we had COVID hit. So what happened with COVID? We had fear of the unknown. We had a shock. A pandemic hadn't happened in a century. We had lockdowns. And with that, we had a big liquidity crunch. So there was a big shift to where can I get cash? Where can I get US dollars? Am I going to keep my job? All of that kind of thing. So with that, obviously the central banks of the world had to do something about it to ensure that people had access to cash, particularly banks and larger institutions, bailout, hedge funds, and all that sort of thing. So that's what you saw in that very, very scary and frantic period in March 2020. So that's basically on 6th of March, around then, the top of Bitcoin, when we saw that big down day on, what was it, the 11th of March, when we lost about 50%.
Hell of a day.
Hell of a day. I remember I wasn't actively participating in crypto at that time. I was trading FX, like the Aussie yen and pairs like that. Okay. So I remember watching it though. I was on the train coming back home from work, and I was like, holy hell.
Yeah, the nuke. Nuke from hell. Yeah, by the way, I should ask you, is it okay to swear on your channel, or is that off kilter?
I don't think YouTube. Cool. I don't think YouTube bans you for that, do they?
No, they don't ban you.
It's fun.
Cool.
Go ahead. So with that, it was just shock, frantic rush for cash, and what's going to happen next. And I think everyone at the time, myself included, were expecting equity valuations to just go further and further south, but
lower.
The central banks of the world stepped in a big way. And that's when you saw the Federal Reserve in particular. So I focus on the Federal Reserve because, they're the most prominent central bank. It said, good morning, mate. It said in the house. So they're the most prominent central bank in the world. And with that, a lot of the volume of crypto is traded in the US, and they've got a big interest in crypto, obviously. So that's another thing that plays into it. But even in the traditional market space, the US drives the markets because they have such a largely developed economy. I think it's number one. China's pushing for that, but at the moment, it's those two.
It's where all the money is.
It's where all the money is. Largest bond market in the world, and it's the capital, the capitalist country of the globe. So a huge amount lies within what the Federal Reserve say. So that's my number one go-to when I'm looking to what's happening in the macro space. Anyway, so the Federal Reserve, the balance sheet, here we go. So what does that mean when that moves higher? So when that moves higher, that means essentially, if you just think of it simply, they're pumping more money into the market, into the economy to keep interest rates low. They're buying bonds. And with this, it's called quantitative easing. So they expanded that QE program when this all broke out. And with that, interest rates, access to cash just became a lot easier.
If you don't mind me stopping you right there, this is also in addition to what was happening from 2008 and 2009, which hadn't really stopped to this period to begin with. Okay.
Yeah, exactly. So if we scroll back, so expansion of the balance sheet, not sure how far the data goes back. 19. So when they were hiking rates back here, so pulling cash back into reserves, and then we saw an expansion, the QE program back in 19, and then a real massive breakout and expansion when COVID broke out. So they did that for a few reasons. They did that to give institutions, give banks, give everyone who needed cash, give them cash, provide liquidity to the markets. And that helped relieve the markets and know that they were going to be essentially bailed out if anything was to escalate by the central bank, the US central bank, and other banks around the world followed the lead of the US.
So basically the idea was we maintain price stability, and that keeps the world afloat during this sort of problematic time.
Exactly. Yeah.
Gotcha.
Just to remove that fear of the unknown. The pandemic might have, the actual medical situation might have ramped up and lockdowns continued, but the market was reassured that the Federal Reserve were going to be there to add liquidity and bail, everyone out. So that's what you've seen. And this balance sheet has just expanded and expanded each month as they continue to buy those bonds. And provide liquidity to the market. So that brought us to mid-2020. So obviously, with that massive shift of liquidity into the market, the Fed just keeps pumping, essentially printing money. As you see the memes on Twitter, the brrr money printer.
Right on.
With that ample liquidity in the market, there's going to be money's going to shift further and further along the risk curve to get the greatest return on their money. So the NASDAQ, equities, all those traditional risk on assets where money goes in hunt of, a large gain or a bit of a gain on that money. Money flowed probably out from the stock market and into crypto, where crypto is a 70 vol asset, whereas equities don't, are nowhere near that level of volatility.
Yeah.
So where are you going to get the largest return on your money? Bitcoin, crypto, and also, I guess, with inflation running hot, Bitcoin's seen as that inflation hedge with that fixed supply. The narrative,
it's got the narrative, right.
It's got the narrative of an inflation hedge, and it's got the narrative of essentially an equity. So risk on, move money, capital growth.
It's being treated like a growth asset, essentially.
Exactly. Yeah. So with that came a little bit of froth in mid-2021, and I think, you like to put reasons to things on why they happen, but sell in May and walk away seasonality. It went through, I remember writing a newsletter at the time about the whole sell in May and walk away idea, but I didn't personally believe it myself because the markets were just in full-on bull mode. I was hesitantly cautious at that time, but in hindsight, sell in May and walk away.
I mean, also, if you're looking for a bit of a catalyst during that time, that was around the Coinbase listing, which I believe was about the 65,000 high. So, kind of an event-driven thing, and then slam it down. And kind of going back into your conversation about institutional players coming in, they do think differently than the average crypto person. Like a lot of those big institutional players or big, asset managers, they're not going to be holding things. They're going to take profit every 5-10%, because that's like amazing to them. And they're also going to buy, the downside when there's a 50% move to the downside, which is exactly what you see right there, actually.
Yep. It's crazy how in hindsight, it's so logical how it's all played out. But in the moment, it's like your emotions take hold of your logical brain and your emotional brain. They're just fighting each other. Yeah. So it's a fun game to play.
Indeed. Yeah.
Obviously that period during the middle of 2021, we still had. So the macro narrative really didn't change that whole time. The only thing that was, kind of weighing on the markets was that consistently high inflation data, which the Fed all throughout 2021 until about October, November, they didn't flip. So they were just saying inflation's transitory and we're not too concerned. We see it peaking and, we're not going to act just yet. And that was their narrative all the way through to Q4 of 2021.
Just out of curiosity, because I feel like you're very well read with this, do you think that they themselves believe that, or is that just something that they pay lip service to? Okay.
Yeah, I think it's, the Federal Reserve, when they release statements, it's, you can say one word wrong and all of a sudden the market misinterprets that and it has a massive impact on asset prices and the way the market moves. So they have to be very careful in what they do and what they don't say. So I think, towards Q2, the back end of Q2, they were still holding on to that transitory idea, but in Q3, it would have been when the switch was flicked that, this is not going away unless we do something about it. So that's why we saw that shift in Q4 and into the minute release in January that, they're not mucking about.
it seemed to me that once Powell got reelected, he's like, okay, all right, so it's not actually transitory anymore, and we're
Yeah,
probably gonna need to hike some rates
that
now
too.
because he's
Exactly.
kind of untouchable now, from what I understand. Like he's gonna
Yep.
be the Fed chairman for a long time.
Exactly. Yeah, he's got another term. So
Hmm.
but with that, I guess that is another thing that might reassure the market as well. I know we're seeing this big
Hmm.
sell-off now, but that might, you get used to a chairman, the
Hmm.
way they speak, the way they act,
Right.
over that period that he's just completed,
Well, to be
and
fair, I
then
mean,
moving.
like throughout his whole lifespan of being the Fed chairman, not one of the times where he spoke did it ever hurt the markets. It would always help, except for in November. That was the first
Yeah,
time where he opened his mouth and things plummeted, basically.
exactly. Yeah, he historically has been a bit of a dove or dovish.
Hmm.
I'd call him a dove, but yeah, he's been quite dovish in his sentiment.
Right on.
So
Yeah.
he hasn't been, a massive hawk. So it's good having that kind of predictability, that
Hmm.
comfort that he provides to smart money and those institutions. They're used to the way he
Right.
speaks and the language that he projects onto the market. So that's a good thing of him staying in his position for now.
Right. And also
Um,
the vice chairman is Brainerd, right? And like
yep,
she's quite dovish, in comparison to even
yep,
Powell himself. So I think that was also a bit of a statement.
exactly. Yeah, so that's good. Um,
Hmm.
and throughout that whole period, the market dumped. You saw this big dump here,
Right.
like we just spoke about. But throughout that whole time, that QE program was still going at the same pace as what it was,
Jesus.
um,
Right.
into, from 2020 onwards.
Hmm.
So with that, the market obviously had another leg up. You saw equities, pretty stable on the way up, that was the
Right.
telling thing. Equities were happy with how the Fed was acting and still
Hmm.
providing liquidity to the market. There was no real shock there. It was only crypto being that highly volatile asset and hugely driven by derivatives that got really overheated that saw the sell off. So I think derivatives, back to our point again, is really driving what happens in the
Hmm.
markets from essentially here on in. So that brings us to November. So that is
Hmm.
when the Federal Reserve commenced their tapering program. So what does that mean? That means that they're pulling back on the amount of liquidity that they're putting into the market each month. So they're pulling back on
Hmm.
that bond purchasing program. They're still purchasing bonds, they're still providing liquidity, but they're not providing as much as what they were previously.
Right.
And funnily enough, that coincided with a bit of a top in both Bitcoin
Hmm.
and in equities as well.
Right.
So through there, you can see it's still going up, but they commenced their tapering program, less liquidity, less money, less capital available to
Right.
take risk. Naturally, you find some kind of top.
Right. And I mean that
Um,
that makes sense because the way that I understand these things, and I'm not an authority on this topic, but the way that I understand these things is that it's always about expectations. And so the second that they start
exactly.
to talk about that, then the
Yep.
market is going to try to price it in. And that's kind of where we're at right now is the way that
Exactly.
I understand it. Is okay.
Exactly.
Gotcha.
Yeah. And I've been big on trying to make people aware of that recently. It's not what they,
Mm,
well, it is what they do, but it's how they speak about what they do and the amount of time
right.
that they give the
Right.
market to price that in.
And theoretically,
So
the market very likely finds a bottom before these things ever really take place.
exactly, unless it's a shock. So
Mm, right.
so let's talk about the December FOMC. So into the meeting,
Hmm.
we saw the market trying to price in the worst. So they knew that the Fed were going to speak about tapering and whether or
Yeah.
not they were going to accelerate that into 2022. So the market naturally,
Hmm.
um, in that week leading up or the weeks leading up, it saw a move lower,
Right.
and that was it pricing. Let's use my arrow actually. And I believe that was it pricing that fact into the market beforehand. So they were predicting what the Fed were going to say and
Uh-oh.
would be
Lose.
sell the rumor and buy the news type of event. So this grey line here is the day of the December FOMC. And, we didn't move a heap in the following days,
Mhm.
but we saw that relief afterwards and we got that little
Right.
bounce. Um, we did get a bounce on the release, actually. If you go down to the lower time frames, there's a big green candle
Yeah.
on Bitcoin. Um, But, the market kind of just stabilized and saw a bit of a relief bounce into the end of December because they'd already priced in the worst case for the December meeting and they were happy to, have some relief, unwind those protective positions that may have been placed into that meeting. And with that, if you're unwinding your short positions, you've got to buy back into the market, or just buy back in general if you were in cash. So that's what I think you saw post that meeting. So this little period here in Bitcoin, and the period here in equities. So, and then we go around on the same roller coaster again for that FOMC minute release. Although I think the FOMC minute release for this meeting in December was a little bit more shocking. The market didn't really expect the Fed to have, as hawkish a tone in that document as what
it was a bit of a pivot.
It was expecting. Yeah, so they pivoted to, we're aggressively reducing our QE program and tapering it down, and we pretty much set to hike 4 times, or they might have said 3 times in 2022, and the market wasn't ready for that just yet. So that's when you get, that sharp move in Bitcoin. I don't know, we might have moved. What did we move over the course of that?
That was your like 47 to 40.
Yeah, so like almost a 10% move.
Yeah,
lower, and then obviously equities felt the effect as well, but then stabilized a little bit as they eventually priced it in, and then into that CPI data. So again, they're pricing in no real bid into the CPI data, but on the event we saw a bit of a spike. The same in equities, and then where we are now. So CPI data, with that, it would either confirm or deny that the Fed, needs to act faster. So if they see inflation running high, there's no reason for the Fed to postpone or push back on their original hiking plan, which was set for pretty much March. And the market, expected 7%, 0.4% increase month on month in December, and that's exactly what we got in that release. So the market had priced in one thing. It was released that that's in fact true, and then we saw a bit of relief. But then again, the market looks ahead to the FOMC meeting, and that's what I spoke about a week ago, last Sunday evening. That this last week past, I did not expect the market to move so far lower from what we've moved, 30%, 40% lower or something. And altcoins have got absolutely whacked, but I did expect a bit of risk off over the last week. So position myself luckily into that idea.
Right. I mean, this whole thing does make sense. I mean, this is perfectly following with what I've been looking at on the technical side, and coming into this next one that you have outlined there. And just I think it's coming this week, right? It's Wednesday, I believe.
Yeah, Wednesday.
It makes sense because the market right now is pricing in, the expectation, which the expectation is the worst. And so if they come out and they say, maybe not 4 rate hikes, we do 3 or anything that's, kind of against that, the market's going to set up for at least a bounce here. I'm not calling a reversal, certainly, but, a nice bounce is, could very easily be set up just from those words.
Exactly. Yeah. It's all about what they say. So there's about a 95% probability that they don't hike in January. So you can basically say, there's no hike this month, and then we look to March. So there's no Fed meeting in February, which I think is a good thing for the markets. They won't have to be anxious and jittery into a key macro event in February. So that could give us the opportunity, if everything goes well in January, and then data, is at consensus or is a little bit below consensus in February, we could get a nice trend evolve into the end of February. Right. I think that's a good opportunity to get long again. But just touching on this again, so you got the Fed meeting on Wednesday, like we've just spoken about. And with that meeting, 95% probability that there's no hike. And we're just worried about what Jerome Powell and his merry men say about the market environment at the moment. Right. So that's what you see there. So positioning for the worst into the meeting, and we're hoping for the best. And if you do get something, a little bit of dovishness. And I think the other thing that's playing into this ahead of the meeting is the markets are crashing, right? So anything that Jerome Powell says has the ability, if he's too hawkish, they'll crash further. And if he's just neutral, they'll probably stabilize. And if he's dovish, it will, we'll see a pump.
Do you think
highly doubt that we see hawkishness from the Fed on Wednesday?
Right. So do you, just kind of a bit off topic, but related, do you think that a lot of this focus now on inflation, which kind of spikes upon these talks of rate hikes and reducing the balance sheet, is born upon kind of the political situation? Like people want to get reelected coming up in America, especially, I think, a little
Yeah,
bit later this year. So they want to
yeah.
kind of focus on that right now so they can say that they've done something. And then, maybe that's not necessarily what they actually want to do. Is that a little bit of hopium or?
I think so. Yeah, I think you've
Mm,
hit the nail on the head there, Eric.
okay.
It's another narrative that's playing about as well. You got
Hmm.
political incentives to act on inflation,
Right.
and kind of they want to see as being doing something about it because there's people out there that are obviously struggling with the higher
Right.
cost of living, and that gives you votes if you're doing something about it. Um,
Hmm.
so there's definitely that incentive as well at play. But I think that's a little bit of a narrative that sits behind what the central banks are doing at the moment. So
Right
for
on.
me, that's
Right on.
key, what they're doing. And I think you can probably get some kind of gauge of what they say into what the president is saying and what the
Hmm.
government is saying, because obviously the two, although they sit independently of each other, they're you can pretty much guarantee that they're
Right. Right.
discussing it and how do we work
Yeah.
this so that we don't cause absolute chaos and that we get
Hmm.
re-elected. So I don't know. There's a little bit of human behavioural science behind it as well, I think.
Right. Right.
Yeah, so FOMC meeting, I think we're setting up for a buy the news type of dynamic into that
Hmm.
meeting, which I'd like to touch on. Well, you're the technical king, so I'd like to see what your thoughts are at the moment, but I'll just finish this chart off. So I think that we could get something, even now, if we start to unwind protective positions, you could see a little bit of a pump into, 40K, and then on the
Yeah.
meeting, it could pump even higher. But it's all speculation at this point. I'd like to see what actually happens at the meeting to try and predict that trend through this period. So we'll know what the Fed say, what they do for, 26th of Jan till the 4th of Feb, until we have another big macro event. So there'll be a nice week or so of price action to take a hold of. So if there's a trend that starts forming, it'll be a short-term trend, but
Right.
if,
Right.
if Bitcoin shows some signs, I think it'd be a good opportunity to jump on a bit of a trend there. And then, so with what the Fed are saying, being quite hawkish, and the market's pricing in
Hmm.
one thing at the moment, which is 4, even 5 rate hikes at the moment. They're starting to price in for December. That leaves, I think that's the worst case scenario at the moment. And the risk is that data starts to undershoot for expectations. So if data starts to undershoot, you see poorer
Yeah.
employment data, you see poorer CPI data, and you see underwhelming other measures of their mandate, which is jobs, rates, and
Hmm.
the economy as a whole.
Right.
They're going to start pulling back on that hawkishness and that aggressive tone that they've shown recently. So I think bad data is good for assets at the moment, and the bull
Hmm.
run to continue. So yeah, if we see underwhelming data in February, and you got the employment data in the first week of the month, and then you've got the
Hmm.
CPI data in the next week, and then we don't have anything really until March 4th again in the
Right.
US. There's a few data points in the US throughout February, but I don't think they'll have a massive say on what the markets do. So really, start of the month, as long as we get through that and we get through this FOMC meeting, I think there'll be a nice bullish trend that develops. And then March, a bit of a shaky environment again, because the market knows they're going to hike rates. It's the March FOMC meeting. I think there we go. So up until here, so you probably see something like this. If the scenario goes as I'm saying, where's my? It's been a long time since I've used arrows on TradingView. There's a tool that shows me a path, isn't there? It's
Yeah.
called Path.
The uh,
Where is it? We're looking straight at it.
are,
Path. Oh, there it is. Yeah. So scenario into this event, into the FOMC meeting, is probably
mhm.
up to 40K. And if we get a good read out of that, it's probably up again. And then a little bit of hesitancy, maybe just a bit of a consolidation, and then something like
Mhm.
this. and then we might get a nice trend that develops something like this, and then hesitancy into those events, and then hopefully moon. I don't know, something like that.
Hopefully,
so just
yeah.
before those events, I think there'll be a little bit of position yourself for the worst.
Yeah.
But yeah, that's my thoughts going into essentially the end of Q1 for the macro side of things.
Super, super interesting. It lines up very well with what I'm looking at right now. So if you're asking my opinion on it, it's, whether Bitcoin puts in a rally from around here at 35, which, there's several technical things that do kind of line up with that, or whether it maybe has one more just last fuck you down to like 32, fills the CME gap from July. Neither of those is that important to me. I am looking for bounces from there, and actually you got those levels pretty much exact. 40, 44, and 48.5 are the big ones that I'm watching. 40 and 44 are meaningless towards any trend, basically.
Can you get your chart up, Eric? Can we get your screen
I
up
can.
again?
I can.
You just want to add it to the screen?
Yeah, let me
to the stream. Sorry,
pull this one up right here. Okay, actually, let's try this one. Yeah, let's work off of this one. This one's simple enough. Okay, let me share a screen. All right, and window. I think it's this one. This one's simple enough right here.
Cool.
Okay, cool. Awesome. So this is monthly Bitcoin. I mean, these are just high probability bounce areas, right? You're coming off the 20 simple right now. There's going to be a lot of people just buying that region because they're closing their shorts. I mean, this is where I'm getting a lot of, take your short, your downside deltas off right now. And, it's not necessarily a buy signal in and of itself, but typically those do lead into bounces. So you have that. Then you also have, of course, CME gap coming in from the July bear trap right here. These are high probability bounce regions, but just as you said, 40,000, it's not that meaningful. And that would be, I believe, just the 382 retracement right here. Let me get rid of this one. I'm focusing on this one in particular, which, the 382, like that's where you expect your corrections to come to within line of the current trend. So that would be in line of the current trend is down. Now, of course, if you do start to trade above there, into middle of February, you probably get to test right around $44,000. Still not really relevant. Your your bull trap area, traditionally speaking, is going to be between these two guys, which is between about 44 and 48 and change. So as long as Bitcoin's below there, it's just it's just a bull trap, and you will actually very quickly realize that, because if you're on a weekly here and you see something like this, that's going to be your proverbial lower high, won't it? And right now we just got our first lower low on the weekly compared to 40,000 in September. The lower high is the next thing coming. And if that actually does happen, that would make me incredibly bearish for, at minimum a test down just below 30. And that's at the point where, I can start to maybe entertain ideas of down to like mid to low $20,000. The hopium, as you said, is that you do something like this and then you flip back around for a higher low and then off to the moon. But there's no way to actually know that. But most things that I'm looking at right now for the higher term timeframes do paint a more downside picture, but a correction coming in like this next few week period, essentially. So I'm kind of the same opinion that, if the Fed comes out on Wednesday and, it's just anything along the lines of, hey, we're not going to be as aggressive as what we were saying before, Mark's going to respond to that quite well. And then kind of the big test is probably in like Marchish region around here, if I had to guess right now, which, as a trader, this is phenomenal. I mean, this is like, more than a $10,000 move on just just a correction, which is amazing.
Exactly.
But for the people who are looking to like hold for the moon for forever, I mean, this market just must be so tiring. It must be so awful.
100%. Yeah.
Right.
I think that's why Twitter's a little bit salty at the moment.
It's absolutely, man.
Have a joke on there right now.
Yeah, man. People really get at each other's throats during these times. I guess the chickens kind of come home to roost for the perma bulls, and it is what it is, man. But that's why we love it, I guess.
That's right.
Yeah.
That's what keeps it interesting.
Man, I wanted to pick your brain a little bit more about some of the tweets that you've that I've seen you put out in the last couple of weeks here. There's a really interesting one that you put out talking about quality prevailing in this next segment of the just the market cycle, meaning that most shitcoins are going to float off into obscurity, and then there'll be some that will be legitimized. But how can you kind of talk about your thought process into how and why that's going to happen, and maybe what's different between now and say like a 2018 where we kind of had a similar sort of thing going on where shitcoins went to the moon with Bitcoin, and then they did their thing, right?
Yeah, for sure. So I think the main point is liquidity. It's all a game of liquidity. So while I call it, the hot ball of money, while that's running hot, you want to be following that. And as soon as it stops, you want to go to quality, because essentially those real revenue generating protocols, coins, are going to have some kind of, viability as an investment idea. And if that thesis holds true, they're generating money, the growth aspect, that value proposition of a coin, a token, should hold, and it should naturally grow as that value proposition materializes. So with Shiba and all those coins that started off with insanely low market caps, that was a prime candidate for the retail guy who got in early and laughed about it, and all of a sudden that hot ball of money has hit that coin, and it takes a lot less capital to move those type of projects. And as soon as retail hears about it, or the wider market hears about it, and that hot ball of money is flowing in, it just goes to the moon. And that hot ball of money has been way larger than it has been in 2013, 2017, given what we've spoken about before. That liquidity, you've got stimulus checks, you've got just access to money is cheaper and easier than it ever has been before. So I think that has a lot to do with it. And that's kind of my idea, that quality will prevail eventually. And while it still may, move down in a bull market, it's going to do something like that rather than that.
Yeah. Well, I mean, that makes sense, right? Because coming out of 2018, we had our own crop of shitcoins during that time, right? Most of them didn't even get past their 2018 highs in 2021, which was, just a phenomenal rally. But I think, but something like Ethereum, for example, regardless of your or my thoughts on the fundamental side of it, it didn't do that. It actually, went up well past its prior all-time highs, and, it looked like people were actually interested in it. So I think that totally makes sense. Do you pay attention to Dixie at all? Does that kind of factor into your DXY dollar index?
Oh, dollar index.
Yeah,
I do. But the thing with the dollar index is, I actually I'll see if I can get my tweet up about this. The thing with the dollar index is it's heavily skewed towards the euro.
Euro dollar.
So it's about a 60 or 70% weighting of the euro dollar in the basket. So the other currencies only make up.
Fair enough.
It could be, but it's still,
that is quite top heavy. Yeah,
a massive weighting towards the euro. And what is the ECB doing at the moment? They're just dovish.
They're printing more.
Dovish as hell, and they're not going to turn away from that. So with that, naturally, the US dollar is going to rocket.
So then
dollar index is going to rocket.
So it would follow, in your opinion, then, that clearly the US Fed or the US central bank matters a lot more than European central bank.
Exactly, especially when you're seeing a divergence at the moment. So in this environment, it's all about the context of the market, I think. So previously, the ECB wasn't as much of a dovish. I always have issues with saying that word, but dovish as they are right now.
Yeah, there we go.
So there's a huge divergence between what the Federal Reserve are doing, getting a lot tighter, hiking rates, and what the ECB are doing. So the euro dollar, euro USD, is going to be, I haven't looked at the chart lately, but I'm sure it's falling off a bit of a cliff at the moment.
Oh, yeah. It's quite nice for myself living over here in Helsinki, I'll tell you that. I wouldn't mind if it continues.
Exactly. So that's what you're seeing. You're seeing, if you pull up I'll bring up my screen now.
I have it right here. This is a quarterly.
Oh, yeah, there you go. Yeah, so you can see pretty much exactly when that divergence started.
Right.
Yeah, so ECB doing one thing and the US Federal Reserve doing the other thing. So that weighs heavily into the DXY, the Dixie.
Right on.
I'm just trying to find the tweet where I kind of explained my thoughts on it.
Okay. Yeah, there's another tweet that I really wanted to ask you about as well, but probably should let you pull this one up first.
Yeah, give me one sec. Oh, here we go.
Okay.
So let's pull this up. Okay. So back in March, here you go. So the dollar index is obviously seeing a huge inflow due to what was happening at the ECB. So you can see this graphic's a little bit blurry, but almost 60% euro in the dollar index. Okay. So it makes up about 60%. And then you've got the Japanese yen that makes up another 13.5. You get the sterling, so the British pound makes up 12%. The Canadian dollar makes up 9%. You got the Swiss franc that makes up 3%, and that's about it. So you can see that it's heavily skewed to what the euro does. And if the ECB are being dovish and they're cutting rates and they're printing money, naturally the currency is going to depreciate in value. And if the US dollar, the US are doing another thing where they're seeing the currency appreciate through tighter policy recently, hiking rates, tapering back on their QE program, the dollar's going to appreciate, and naturally you just see a big divergence, and it's a pretty easy trade if you wanted to play that central bank divergence. And you see it, you don't see it very often, but you do see it from time to time. I remember that the Australian and New Zealand central banks were doing a similar thing about a year ago or 2 years ago. It's a bit of a divergence in their key rates and what they were thinking.
Interesting.
But yeah, that's a good FX trade, and that's one that no doubt those bigger players take advantage of when they do pop up.
Right. So basically, to kind of wrap up what you're saying, it's not the best way of looking at things, simply because it's the dollar's value relative to a basket of other currencies, not like the dollar's like absolute value.
Yeah,
which
exactly.
for all I understand is like not something that is charted or chartable. It always has to be compared, whether it be to other currencies or assets or what might have you. Do you ever pay attention to tether dominance then by chance? That's something I found a lot of value in myself.
Yeah, I don't, to be honest. Do you want to pull it up?
Yeah. Pass me the screen. Yeah, man, this one's super interesting to me. Oops, this is not it right here. Where's, well, whatever, I can just...
So is that its dominance relative to other stables?
No, dominance relative to the overall market cap. So it's Tether versus basically all of the cryptos, weighted heavily, I believe, towards Bitcoin, if I'm not mistaken. Anyways, here, I think it's just going to be best to show with an example. Take off my damn moving averages and just compare to Bitcoin straight up. Bitcoin in orange, Tether dominance in cyan right there. Where's log? Yeah, there we go. And they obviously play opposite to each other more often than not, except for this 2019 rally right here. But theoretically, it would kind of make sense in the sense that, okay, Tether dominance going up, meaning that, market cap's coming into Tether relative to other cryptos. And when does that happen? That happens when people, want to take risk off, right? So in this case, and what I'm kind of watching right here is that Tether dominance, if I'm just looking at this chart from a from a traditional technical standpoint, I mean, this is obviously an up chart, and it is like kind of about to break out here, which would be problematic for Bitcoin if that relationship does hold up. So just something, something that I've been following here, although short term probably does pull back, to be fair. I mean, you are kind of testing your prior highs, but yeah, ultimately, that also kind of has me a little bit more concerned that, we could see a washout. The other thing that I wanted to ask you about, and I'll just bring it into the view here. Where's, it's right there. Is actually the open interest, right? So this is something I've been tracking a lot recently as well, kind of off the back of what you're saying, although they didn't really make that I didn't really make that connection until, I spoke with you, but, obviously more players involved, open interest becomes, and more derivative, just driven action, this becomes more and more relevant. And, this is, I mean, it looks to me like it's going for a great reset right here. It's like, that's the real great reset, if there is one. And so I keep on looking at this, and it's like, if we are going to, if liquidity is going to be pulled from these markets, which, taper talk does seem like there's no real question around it. Like, kind of has to happen. 9 trillion is just that's ridiculous. It's too much.
Exactly.
I can't even conceptualize that number.
There's no denying the fact that liquidity is literally being pulled from the market. So yeah,
dude, you want to know something crazy that I just learned? Okay, I used to think that when they, expanded the balance sheet, that they were like literally printing off more, dollar bills, like that meme, right? With Jerome Powell,
Right, yeah.
dude, it's not like that at all. They just fucking go into a database and add some more zeros every day. Like it seems so, I don't know, it just seems kind of gross. Anyways,
Magic internet money.
yeah, exactly, exactly. So, this right here, it would make sense to see this, absolutely catastrophically fall, which has been more correlated to downside price action as well, just, with, I guess, less free money abound. So just another thing that I've been looking at. But yeah, man.
Just back on that. Sorry, Eric.
Yep.
Just back on the US dollar tether
okay.
dominance. If you invert the Bitcoin chart, how does that look?
Let's see. If I invert only Bitcoin,
invert
scale. Yeah. It looks rather similar, actually.
Yeah, I'm just
except
thinking
for this portion right here.
Yeah, it's strange.
The only one. Yeah. That is rather
strange. Wondering if that's a function of them minting more tether or
that's a really good point. Oh yeah, I didn't consider that. That is really profound, actually. Yeah.
Huh. Yeah. So I don't know.
Yeah, I guess that would make sense too.
Food for thought.
Man. Yeah, you just blew my fucking mind, man.
You can see the correlation recently is like essentially spot on.
Right.
I don't think there's too much edge in it recently, but previously it seems there could have been.
Yeah. There's another tweet that I wanted to speak about. So you put out a tweet about put and call ratios being the highest and heavily weighted toward puts right now. On that tweet, correct me if I'm wrong, but I didn't actually see the data with that statement. Could you show that? Just because to me that would be like super interesting, because there are some like very obvious calls to be made about that. If it truly is like an outlier, for example, it's like Okay.
This one, yeah.
Yeah, that's it. Okay. So there was a trend, just blind.
I'll bring up the place where I got it. So Levitas, awesome site for derivatives data.
Okay.
So if you're interested, jump in there. I'm looking at this daily, pretty much.
Sweet. Okay.
So Deribit being the largest options writer by volume, looking at their volatility data. This is where you'll find the skew. So over in the top right here is 25 delta skew. So what is that? Essentially, I actually wrote a thread on this. I'll have to dig it up a little bit later. But it's showing the relative expensiveness of puts to calls. So a higher 25 delta skew implies that puts are trading more expensive than what calls are. And then a lower 25 delta skew implies that calls are trading more expensive to puts. So that would be bullish. Right. So calls being a bullish bet on market direction, and then puts being a bearish bet on market direction. So if I bring that up here, you can see, actually, let's go all the way back to, it's quite interesting. I actually marked out the bottoms and the tops, and it lines exactly up with price action. So you can look at 7-day dated skew, you can look at 30-day, 60-day, but the ones I focus on are 7-day, 30-day. Obviously looking for what's, over more than a 30-day period, you can have a lot change. But within that 30 days, within a month time frame, you don't generally depict or have a better idea on what's going to happen. So view full screen. Okay, so October 20, so anything above zero, so you see the zero line here, implies that puts are trading more expensive than calls, zero being that equilibrium. And typically, you saw that big bull run, we were trading heavily below zero, which was bulls are in control. And it shows that sentiment. It doesn't really imply, you can't gauge a lot from it, but you can pick out key levels and pick out what sentiment is. And with the options market being typically those more sophisticated investors or traders, it's a good place to look and see what their sentiment is. So if we're trading, really high, that can imply that they're bearish. And if we're trading really low, it can imply that they're bullish. Or if you see a top form, we're coming back down to a bullish type of sentiment. And then the opposite is true for when we move up. So it's funny how these line up. So, it really moved higher into that May crash. So where were we? January, it kind of bottomed out and then moved drastically higher into April. So
Right.
April 25th, actually, and then saw a top, but then spiked again into that crash, which I believe was around May 16 or something like that. And so up here, the market crashed. And that's when you saw puts in heavy demand, trading more expensively. And then towards, July is when the markets found a bottom and we had bullish sentiment. And then again, in September, we had another crash. In, I think, mid to late September, we had a crash. Again, it spiked and moved lower. And typically this happens ahead of time. But it's most of the time, it's only in hindsight. You can be like, oh, it was so obvious, skew, ripped, and it topped here. But, you can kind of gauge if we look at, scrolling back a little bit. Let's go to July. Is it going to load?
Oh.
Anyway, it's not going to play ball. But yeah, you can see what I'm saying. When it bottoms out and moves higher, that's a bearish sentiment. And then when it tops out and moves lower, it means that we're heading for a bit of a bullish move. So you can see what it's doing right now. Historical kind of resistance, if you want to look at that, up at around 20. And that's where we are at the moment. So it's pushing up into that high of the range. Well,
that makes sense. I mean, people are buying it more, implied volatility spikes up and what's going to happen with most of these options? Well, 80% of the time they're going to expire fucking worthless. And that's just the name of the game, unfortunately. And one of the weird things when I was a market maker authorized trader is that when like big orders started to come down and, people would come in, like there'd be a call in like, hey, we want to buy, 150,000 lot of puts or calls. It's almost always on major highs and major lows when those things were done. So very, very interesting that you actually have this data right here, because I've actually been unable to find that in like a trustworthy manner. So this is amazing, man. So this is Levitas.
Levitas, yeah. They've actually improved I think the charts are still a little bit ugly, but they're working on it.
Doesn't matter. That's beautiful.
Found these guys, in the beginning of 2020, and I've been hooked ever since. It's been my go-to for all things derivatives, really. So they've got futures data as well. So you've got funding data, which is another big thing to watch. So you can see that we're this one up here. So funding data, you'll probably see a lot of it spoken about on social media and Twitter.
Right, financing.
But the rate itself is not really that significant until you take into account the open interests. So this is really good. It shows the open interest weighted funding rate across exchanges.
Oh, that is amazing. Okay.
Yeah, so at the moment it's really below zero. Implies that bears are in control, and that leaves them susceptible to a bit of a squeeze. So I'm always watching that as well.
Right.
Yeah, so there's so many cool things on here. You probably have to Google, for those that aren't, I guess, fully aware of all these different metrics. Google them, and I'm sure you'll find an answer.
That's incredible, man.
Yeah.
Do you have an opinion? It seems to me that this coming year, based off of what Gary Gensler has said, the SEC chairman, he seems to be very focused on kind of stopping these like wild west crypto exchanges. Do you have any opinion on, what that whole situation is going to look like from a macro standpoint?
Yeah, it's interesting. There's actually a bit of chatter about between some people that I talk macro to day to day. So there's a little bit around stablecoin regulation, which will be the big one.
Right.
So what they do, USDC being essentially a centralized stable coin, because you've got Coinbase backing it, and they're now listed on a public trading. So they're publicly traded, sorry. So with that comes obviously legal responsibilities and responsibilities to uphold regulation. And so that'll be interesting what happens with USDC and Tether. There's always Tether FUD going about, but I think the whole thing around stablecoins, Jerome Powell actually recently spoke about that, as long as they're well regulated and they abide by any legislation, there's no need for them to be delisted or unable to be traded. They can exist alongside, a digital US dollar or stable coins that are backed by central banks. So he did say that. He did say I think, what did he say? He said, no, I tweeted about it actually. Let's have a look. Just excuse me while I
No problem, man.
The
By the
Twitter
way, just in
search
the
function is not the greatest.
dude, it's the worst. By the way, someone in the comment section asked, "What did you study?" Or if assuming that you went to university, did you study anything that's like correlated with what you do here? Or
I'm
he
actually
basically
an
wants to know where you
engineer.
learned all this. Oh, you're an
Yeah.
engineer. Okay, probably
Yeah,
way better than
so
economics, to be honest with
I
you.
did
I just
do some elective subjects in economics, but they
yeah.
were useless.
Yeah, dude, I felt the same way, man. I got a degree in economics. It was just a fucking
Yeah,
waste of
right.
time.
Yeah. I can't find the tweet, typical Twitter. But anyway, yeah, Jerome Powell said it's not a massive issue at the moment for other stablecoins to sit alongside a potentially a US digital dollar. So
Okay, so it's kind of a
that's
vote of
promising.
confidence. That seems to me, and maybe this is just hopium, but it seems to me with the focus on washing out some of these like wild west 100x exchanges, but also still having these regulated sort of entities. It doesn't seem to me like the Fed or the SEC is looking at banning any of this at all. What they seem to be looking at is legitimizing it as they build
Yeah.
up all the infrastructure kind of around the space. And forgive me if this is a little bit too bula hopium here, but maybe that aligns with or opens up the road towards a Bitcoin spot ETF.
Yeah.
Maybe not
That
this
will
year,
be a
but maybe
big thing.
next year. Yeah, I figured
Yeah,
that
it
would
got
be a
rejected
humongous
recently,
thing.
didn't it?
Yeah.
There's a
So
few that were proposed, but they got rejected earlier, I
right.
think this year.
No, I think extremely unlikely. The biggest hoping would be maybe like after Q2, Q3, maybe. But I think even
Yeah.
that might be too soon because they got to wash out like BitMEX still. They got to wash out. Maybe Deribit makes it because they've kind of played ball the whole way through. But Bybit, Femex, all these guys who are really seem to be where like a lot of the volume is coming from. Seems to me
Yeah.
like those are going to be under like intense scrutiny and probably out the
Definitely.
door soon enough, which is kind of the end of the era, man. I mean, we've
Yeah.
been
Yeah.
loving these things for the past few years, but it kind of has
Exactly.
to
And
go.
that's why you
Nope.
see FTX shifting
Mm,
so
yeah,
significantly to,
absolutely.
holding the regulator's hands. You
Right.
see Sam going
Right.
to all of these, testimonies.
Yeah.
It's quite obvious what they're trying to do.
Right. Exactly. Do you have an opinion on Sam just in general?
Oh, I think he's a legend.
Yeah. Amazing.
Yeah.
Amazing, man.
Yeah. I
Yeah.
mean, I haven't met the
Absolutely.
bloke, obviously, but yeah, what he's done for the space and what he's been able to do with
Mhm.
FTX over the last 2 to 3 years has been just insane.
Yeah. Absolutely, man. I mean, Jesus
Massive
Christ, like
kudos.
he's buying all sorts of NBA teams and MLB, and it's just
Yeah.
incredible where that's come towards. I was gonna ask one last thing, but it just slipped my mind. Damn it. Um, Maybe that's a good place to end it. What do you
Yeah.
think? Dude, this has
Yeah. It's
been
been
absolutely
great.
phenomenal. Absolutely phenomenal. I'm going to obviously have all of Ted's socials links in the description below, of course. Please check him out. He's amazing. He explains things, as you've seen here, in an incredible way, a very easy to digest way, and also a helpful and valuable way as well.
I hope
So
so.
I think that's a beautiful way to kind of leave it off. Hopefully, we can do one of these sometime soon. Maybe after the next sort of February or March events would be incredible. But
Yep.
yeah, man, that'd be amazing. So with that said,
Awesome.
amazing. Take care,
Yeah.
and we'll see you on the next one.
Thanks, Eric. Appreciate it, mate. Catch ya.